Welcome to the Tower Wealth Advisory Podcast Series. I'm Tyler.
I'm Dave.
And today we're chatting about flow-through shares and how we're using tax credits for investment returns. So a bit of a different strategy. I guess not a lot of people use flow-through shares. We've got some slides here that'll dive into how they work and who uses them and why they use them. So maybe it's easiest if we just jump into them. So we'll flip ahead here.
Sounds good.
So the first bullet point would be that certain corporations in the mining, oil and gas, and renewable energy and energy conservation sectors may issue flow-through shares to help finance their exploration and project development activities. The flow-through shares must be newly issued shares that have the attributes generally attached to common shares. So what does that mean in layman's terms, Dave?
It basically means, these exploration companies are not profit-generating companies. The only time they'll ever see a profit is if they find something, and they would generally turn around and sell that discovery to a company who is a mining or drilling operation. So what you end up having is, if you look at the books for these companies, they have tons of expenses and no income. So in order to ensure that we still have people out there trying to find stuff, we get exploration credits, and those exploration credits are flowed through to the individual shareholder, whereas in most situations with most common stock, you can't flow through expenses to the individual shareholder. So ultimately what you're doing is allowing someone who invests in one of these flow-through shares to receive the expenses as a deduction for them taking that kind of risk to buy something exploration or a piece of that exploration.
Gotcha. Okay. So we don't have to do the rest of the presentation. That pretty much sums it up. What you're trying to do is invest in a company that has no growth, which is unusual, right?
Right.
Normally, you don't want to go and invest in a company that just has losses. That's a bad investment.
Yeah.
But in these situations, these are flow-through share offerings where those flow-through shares are flowing through expenses to the shareholders.
Pretty much it.
Pretty much.
I mean, the risk is high, though. I mean, let's. I don't know when we're going to tap into that. Yeah. So maybe let's roll along a bit, and we'll see some of these pieces here.
So this is a bit of a chart, I guess, that describes the movement of money. And Dave already touched on it. But as an investor, you're investing in a flow-through limited partnership. That's the blue box in the center there. That limited partnership is giving its money into that Canadian resources company. That resource company is then flowing back the Canadian exploration expenses into the flow-through partnership. Mm-hmm. And then that partnership is taking those expenses and giving them to the investors.
Right. So in essence, you get this deduction and you write it off against your taxes. So if you think about an RSP, you put $10,000 into your RSP, it reduces your taxable income by $10,000. Now, during your getting taxed at source from your employer, you've paid tax on that $10,000. So what you end up doing is getting back tax that you've already paid. So you're deferring taxation to a future point when you draw that money out of your RSP. Very similar to this. You're getting a deduction, but you're going to owe some tax on some of that money at some point in the future when some of the return comes back in the end.
Okay. So who would use flow-through shares? Well, these are people that want to deduct from income through renounced expenses and an investment tax credit on flow-through mining expenditures for individuals. So these are people that are looking for additional tax deductions. It's not for somebody who's maybe, still has room in their RSPs, can still deduct there. These are people that are maybe beyond that. They've already topped up their RSPs. Yep. Either maybe it's happening inside of their pension plan. That's eliminating their ability to have RSP room.
It's a big one, yeah.
So they're looking for further tax credits. So that's who this is.
Well, and I think somebody as well, anybody who might have a high tax year for whatever reason could have sold a second property, could have sold some investments. These are non-registered type things that are triggering a large capital gain, a taxable capital gain. So how else can you find something to reduce your income when you have no RSP room left? There's not much. So this is definitely one of the ways. So maybe even somebody with a corporation.
Sold their business? Or?
Well, not necessarily sold the business. That it could be selling their business, a big capital gain year, but think of it maybe just operationally. They're operating their business. They want to stay under the small business capital gains limit. So once they hit a certain amount of profit inside their corporation, they have to pay out that money above that number to themselves personally as income in order to keep their business qualified as a small business. So they could end up with a $400,000 management fee out of their corporation or a dividend. That's going to be a big tax bill. So they can redirect some of that money to something like a flow through to offset the taxability of that number.
Gotcha. So it works for a few people.
Yeah.
So what do the tax savings look like? So a tax deduction and credits of over 100% in the first year and up to 130% over the life of the partnership. Additionally, the partnership provides provincial tax credits for residents in BC, Saskatchewan, Manitoba, and Ontario for qualified mining investments. But we'll do a slide here that kind of gives a tax illustration breakdown. So this is an example of two options here. Somebody who's invested $2,500 and somebody who's invested $5,000, and they're at tax rates of 42%. So you can see the immediate tax savings of, about $1,000 in the first example and $2,100 in the second example. So that's a 50% tax savings in the first year when you include the income tax credit savings that are applied to this. So if you look at your total tax savings at the bottom, that's really what you're referencing. So in that tax bracket of 42%, you're at a 50% credit.
Right. So, and for the most part too, like, with the minimum you're showing there and the alternate, I mean, they're both pretty much the same rate. Yeah, just doubled up.
The only time it changes is if the tax rate changes.
So, from the slide before too, you get a tax credit, and then some of the provinces have some credits that they combine on top. So they range based on where you live, province that you file your taxes in. So it could range anywhere from that 100 to 130. Yeah. And that's primarily based on your province of residence makes a big difference. And sometimes it doesn't all happen in the first year. You might get a little bit that happens in the second year, depending on the operations of. So if you think about it, on the flow through, you can buy flow through shares, or just like you can buy an individual stock. If you're someone who has a portfolio and you buy individual stock, you pick your stocks and that's what you hold. Same thing with flow throughs. You can go out and buy individual flow throughs. They're out there, and that's your holding. Or you can purchase a basket of stock. In a mutual fund, you can purchase a basket of flow-throughs from various corporations. So you're basically paying a manager to pick the flow-throughs and find the offerings that are, because they're up each year, right? So you want to diversify because, with flow-throughs, you could own one that's worth 0 at the end of the year, and you could own one that's gone up 10 times because they found something.
Right.
So you don't want to bet your contribution every year on 0 or 10 times. I mean, it's pretty dangerous.
Yeah, and I guess the nice thing in these examples here, and I think I make the note there, a negative return. Technically, if you make a negative return in your investment of minus 50% year, you're break even on your investment just thanks to the tax savings.
In rudimentary math, that's exactly it. Right. You have, so you're buying something hoping that it doesn't go down 50%. If it does, you're like, oh, well, it's like a 0 year on the market for you.
Yeah.
Yeah. If it goes down 30%, you're up 20. And this is the reason why this is somewhat hard is because you're relying on your tax refund to form part of your return. And sometimes people, when they're looking at rates of return investments, and this because we deal with this all the time, people look at what's posted online or on a newspaper, and they never look at what's their true rate of return. When we ask people, what's your rate of return after tax? What's your rate of return after fees?
Yeah.
They're like, I don't know. Like, well, it's like buying a GIC at 2%, and they're going, well, at least I'm getting 2%. I'm thinking, well, actually, you're losing 1% in tax, and inflation's eroding the rest.
Yeah.
So I mean,
you're getting a minus.
So people just look at what their return is, and they never go back to their tax return to see how much that return got lost in their tax return. So this is very tax return related.
Right. Performance.
Return on investment performance. Yeah.
Further tax savings can be achieved if the investor rolls the purchase into an RSP. So this brings the credit up to 66%. So in the example that I have up here is, again, the same numbers, $2,500 or an alternate $5,000 contribution. You can see the total tax savings down at the bottom. Now, again, this is using the RSP vehicle. So actually purchasing the flow-through share in the wrapper of an RSP contribution.
Right.
So now you get a contribution credit for depositing to an RSP.
Yeah, and I'm not a huge fan of doing that one per se, only in the sense that, you don't, anything you lose in your RSP, you can't, it's lost. There's no writing it off. Right. That's true, that's the tough thing about an RSP. I do like the charity one, because that's what we do with a lot of clients.
We've done more of those. Yeah.
The example always is we have clients who give somewhere between $5,000 and $10,000 a year to charities. All they do instead is they buy a flow through. They get a write off for the flow through, and then they donate the shares in kind. Now, the thing about a flow through is you can't donate the shares of a flow through to a charity. So once the flow through matures, it matures into a vehicle. Usually they roll it over to a mutual fund or something like that. If it's a pool, which is what we use, then you can donate the pool or the new mutual fund in kind to a charity. And you achieve two things. I don't know if that's in the next slide, that you don't pay tax on the capital gain.
Right.
Now, when it rolls over from the flow through to the pooled funds or the mutual fund, it does technically trigger whatever gain is outstanding at that point. But still, you're donating your shares in kind, which it's a two-step procedure for both of these. You're just finding a vehicle for it that gets you an additional tax write-off.
Additional credit.
Yeah.
So it makes it pretty appetizing, I guess, when you look at that tax credit there on the charity side. The 72%.
The tax charity. I mean, you're putting $5,000 through this process or the strategy, and you're getting back almost $3,600.
Yeah, your true cost of investing is $1,400,
right,
to get a $5,000.
And I think now this is showing, for example, in the alternate, $5,000 being moved over to a donation. Well, we kind of know already that when you buy this flow through, we typically look at the one that we've used. We kind of aim for 70% or 75% of the flow through's value at the end of a year. It's not, you put in $5, it's worth $37.50. So you're not really donating $5, but in this case, you're still quite a ways ahead. So if we just tweak these numbers a little bit, maybe a few $100 and said you're $3,200 on the tax savings, what it really means is you're $1,800 out of pocket to donate $3,700. That's pretty good. So
nice.
Charity wins, you win. I guess the people of Canada lose a bit, if you want to look at it that
way. Are flow-through shares right for me? Well, they're extremely speculative by design and are therefore extremely volatile with no promise of return. The exploratory nature of mining is in itself very risky. So most often, flow-through shares post negative returns, and they can post 100% loss. As shown with some positive performance, gains can be significant due to the upfront tax savings. Even negative years are positive investor performance. So as we discussed, they're positive because of the tax credits that were received. So an important note to make here, of course, is you're going to have to talk to an expert in this area, someone with experience and knowledge who not only knows flow-through shares themselves, but knows you and your appetite for risk in the tax situation you're in. And I think that's almost the most important point right there at the very end point, the tax situation you're in, because that dramatically affects what the result is in this type of investment strategy.
Yeah, for sure. I mean, the caution on here is they're just not right for most people. I would say for us, when we look at our clients and we would say this makes sense for maybe 20% of them. And of those 20%, 20% of those are comfortable using this vehicle, which means 4%.
Yeah. So
you can only imagine of the general public what that percentage would be. I think the other cautionary tales on this too are a lot of these flow through shares, and not in the pool version that we use, but just a straight up new offering of a flow through share. A lot of these are just garbage, just like a lot of things out there. And I know that's probably a really harsh word, but sometimes people selling these, they're getting a commission to sell that share. So it's a transactional based piece of business. And so, if you think about that, if someone's being paid a large commission to sell a flow through share, you're already behind the eight ball before the money's even been invested in this holding. So I prefer the pools that we use because there is no upfront commission or charge on it, and it's an advisory fee. And that really ties to the performance. Your advisor only gets paid, based on the value of that holding. If the holding goes to nothing, well, then you're out some money and your advisor's out some money. So I like it tied that way. And I prefer in this space to have a manager who's an expert on purchasing those holdings. They also have purchasing power, which means the upfront cost to them is a lot less than the individual trying to buy one particular stock or flow through to get this credit. That's a big risk, I find.
Yeah. Yeah, well, that's about, I think, all that we have for talking about flow-through shares today. Unless there's any other comments you want to add, Dave?
No, I think they're great in the circumstances, and I think there's a lot of people who are in the right circumstance for this and have no idea that this is a great vehicle for their situation.
Yeah, I agree. So thank you very much for catching this episode of the Tower Wealth Advisory podcast series. If you want to learn more about us, follow us on our social media or find us at towerwealth.com.